Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Markify. I'm your co-host, Joel Alconin, along with Dennis Dick, and we have a special guest on today. It's Jeffrey Hirsch. He is editor-in-chief of the Stock Traders Almanac. Jeff, how you doing this morning?
I'm great. How are you guys?
We're doing good. We got our nice almanac here for 2015 in front of us, and you guys put together a lot of great information as always. Do you have any highlights here that people should be taking a look at?
Well, I did have a chance to bump into Raz out in Vegas at the Traders Expo, so that was a little bit of a highlight.
Okay, that sounds good.
And one of the things I was talking about out there, which is very pertinent, is trading the Thanksgiving market. We did get the upside on the Friday last week of triple witching, which was sort of in line with seasonal patterns. We are seeing some potential strength today, but what we like to do is, hopefully people are already long, but if they're going to do some short-term trading around that Wednesday-Friday combination, which has been somewhat bullish over the years, any weakness today you can get in and sell any rallies, take some profits, or, of course, ride the whole year-end rally into the Santa Claus rally, and some of the things that we're looking at right now.
So the retail stocks, is that usually what rallies the most there on the Wednesday and the Friday there, Jeff?
No, it's a general like S&P, Nasdaq, QQQ type of rally. Also, the small caps are starting to come into favor. So it's not really a retail rally. I mean, everyone wants to just think it's retail stocks, but most of the sectors, stock index sectors, are in play and bullish. I own most of them right now through ETFs. We start to get into that stuff in October. So it's bullish across the board, and it's the sweet spot of the 4-year cycle. Fourth quarter of the midterm year into the first 2 quarters of the pre-election year. The only caution, a couple things, is the first half of December tends to be a little bit weaker than the second half of tax law selling. In January, there's been a lot of profit taking. So just looking out a little bit further than the couple of days, I want to be wary of that for any sort of short term or sort of swing type trading that you're doing. But as for sectors, we're pretty much all in on a lot of things right now. I mean, it's just across the board.
So you don't see any reason here for concern coming into the end of the year. Typically, it's strong going into the end of the year, while the Santa Claus rally eventually coming up here as well.
Well,
You
the thing about the Santa Claus rally is people often sort of use it improperly. The Santa Claus rally, if you turn to page 112, I think, if memory serves, of your Stock Traders Almanac that you have in there, is
Okay.
the last 5 days of the year plus the first 2 of the year. It's a short thing, and it's really a period of time that's just got a bullish bias, not excessively. It's about a 1.5% gain. And the importance is that if it doesn't rally, then something's awry. And there's a phrase that Yale, the founder, my father, came up with called, "If Santa Claus should fail to call, bears may come to Broaden Wall." We've seen that the last 4 times, either a flat year or a nasty bear market. So the year-end rally is what we're in, the best 3 months of the year. I think the turn of the year is where we'll be looking. The January break has been more pronounced recently, and I think we'll start to feel some of the rate hike fears, whether we actually get a hike or not. That'll start to come into the mix. And there's also seems to be a lot of profit taking in January these days. The last couple of decades, as opposed to the January effect, which is stocks going to go up in January plus small caps outperforming large caps. Most of that happened in the last half of December now.
So when did your dad start the Stock Traders Almanac?
Well, he started pretty much while I was still cooking. I was born in '66. The Almanac research was 1966. The first edition came out in '67. It was the 1968 edition, and the 2015 is the 48th edition. So I grow with the Almanac. I'm the same age as it.
So when you were going to your Christmas stocking when you were 2 years old, the Trader's Almanac, that was the first thing that was in there, right?
I got my copy signed by Dad. I have a few of them on the shelf. But I also shipped them out to most people back in the days when I was in high school and college. I would pack up the books I learned in the mailroom, running the Pitney Bowes machine, and packing up books, putting on labels and stuff. So I did it all. Learned everything. So you get a feel for it.
So it must have been back then. I mean, it just must have been an entirely different process, for considering the age of computers and the developments and stuff, is rolling with the changes now. It must be a heck of a lot easier to put everything together.
Oh my God, we used to run the daily down, the half-hourly figures with a pen and paper using an adding machine. And then in about '92, I converted it to DOS, Excel, DOS for Excel, Excel for DOS, excuse me. And now it's SQL Server database, Visual Basic type. I don't even program that stuff. I have somebody that takes care of that. So it's a lot. It's a lot more. We put it out a lot faster. It's what used to take many months takes days or weeks to. You still got to read it and check it and proof it and make sure that it's accurate. That's the part that's most time consuming. But the crunching of the numbers is definitely 10 times faster, if not more.
So
Speaking of,
go ahead,
I was going to
Dennis.
say, speaking of algorithms, do you think there's any traders out there or algorithmic traders that automate all the strategies and all the seasonal patterns there from the Stock Traders Almanac?
Not all, but I am starting to work with some people that are.
Okay.
There's a couple of funds out there. I know it's hard because history is a guide, as Sam Stovall says. It's not a gospel. Things do change. You can't just. There's one of the things that works really well is the best 6 months. That's been proven by scientists that it's got predictive power, but the seasonalities don't always set up as they do on average. You have to use a little bit of, you have to read it, like you're reading a defense. If you're Peyton Manning or something, you go in there and you see the setup and, you look at your technical indicators and pull the trigger. So it's not necessarily just black box algorithmic stuff. It gives you, a good base, a good guide for trading, whether it's, gold or oil or S&Ps or retail stocks, whatever it might be.
So how close of a time? I mean, do you get up every morning and then you're trading? You have your positions. I mean, do you rely on this on a daily
I do.
basis?
We rely on it over. I'm not a day trader. I don't sit and intraday trade at all. I'll swing trade a little bit, but the trades that I make are either taking some profits or cutting a loser. We're taking positions. Some of them are different periods of time depending upon what the seasonality, or if it keeps winning and goes on beyond the seasonality, I'm going to let that ride. So I get up every morning, I look at the market, we check our positions, we look at what's coming around in the next weeks and months, what's setting up, but I do not trade it out like a lot of people do. Some people make a lot of money doing that. That's not my style.
Okay, you try and stick with the long term. So just moving on. I mean, this has been it's been kind of a crazy year. I mean, it's obviously a great year of returns for the market. Had that little bump in October and stuff, but just taking
kind of interesting how that happened in October again, wasn't it?
yeah, it is. It is. Did that fit into any of your seasonal patterns?
That is one of the seasonal patterns. That is. I mean, October phobia. I mean, look, it's. I was talking about it in August. I had a guy come up to me in Vegas. He said, you were right in August. I was at the show in San Francisco. He's like, you said there was going to be a correction, and there was. It was just because the third quarter is a really volatile time, and that changeover, that, difference between the end of the third quarter and the beginning of the fourth is a volatile period of time for society, for the market society. People tend to do the similar types of things every year, and it sort of feeds on itself a little bit.
Do you have any longer term guidance here? Because I'm just looking, this has been like a 5-year bull run. And do you know any, just off the top of your head, do you know any of the longer term seasonal patterns? Like how long do these typical bull runs last? Because we obviously had the big washout in 2008 and 2009. And since then we've been straight up. Is there any guidance like looking, to the past at some of, major events, like how long these bull runs can last after these huge washouts?
This is towards the longer end of the bull runs, but I mean there are some long-term patterns, and I don't know if I call them the seasonalities at that point. They're a little more cyclical, cycles.
Yeah.
There's the 4-year cycle. I mean, I put out a book in 2010 based upon a forecast that Yale made in '76 for a 500% move in the market off the '09 lows, and people were sort of incredulous at the time. Now it seems a lot more plausible. So that whole forecast and that whole outlook, which I will reserve the right to augment it as things change over time, which I have a little bit, but it calls for, another blow point. I raised the floor on that, sometime in the 2017-18, the next, post-election midterm year in the cycle. And and then we're looking for a huge rally up to. It calls for Dow 38,820 by the year 2025. So that's the long-term outlook. Between now and then, I think we're going to come up against some difficult times. The election years have gotten banged up a bit recently. We had 2008 and 2000. I think the next cycle, the next president's going to have a rough time of it. There's going to be a lot of issues to deal with. We're seeing some of that here with the midterms. And I suspect that we'll get most of that pre-election year move in the first half and kind of a little bit more perhaps in the second half of 2015. And after that, I'm going to be a little bit more defensive, a little more concerned going forward. We're you don't want to say we're due for a bear market because it comes when it comes, but we're going to have another one at some point in the future. That's pretty much guaranteed. It's about when and how deep. And I suspect that in the 2016 to 2018 period is when we'll feel.
What was that target again you gave us, Jeff? What was that target?
The Dow.
38,820 on the Dow. It's on the cover of my book called Super Boom, which was based on a forecast or a projection we put out to our subscribers in the newsletter in May 2010. And I think almost the biggest value in that book is in the back in the appendix is a reprint of the 1976 special report that my father put out forecasting a move to Dow 3420. It actually came out in early '77. It was based on a bunch of articles he did in the newsletter service he had back then in '76.
And where was the Dow in '76? It was probably like 600 or something, wasn't it?
Well, it was off the intraday low of 570,
Yeah.
which was 74.
Okay.
But at the time, I think it was probably around 1,000, working in the 800 and 1,000 range. And it's based upon some non-specific time periods, based upon events and changes in things. It's war and inflation, and then the inflation leveling off. You look at the secular markets. We had a 8-year secular bull market in the 20s. We had a 25-year bear market in the 30s, or plus. And then everyone gets hung up on this 18-year or 17.5-year. It's more event-driven than actual time cycles. I think when you have a big global military action and then the inflation that is associated with that, and there's one other factor that creates these booms. It's something I refer to as a paradigm-shifting, culturally enabling technology, like the automobile or the television or the microprocessor / internet, cell phone, that whole technology revolution that we're in right now. So something's coming up. I don't know what it is. I'm not that smart. It might be something being developed in some lab somewhere, some garage, but there's a few industries that I think potentially could be there. I like biotech a lot going forward. I have a position in the IBB for that trade. And there was an acronym I heard on the radio the other day on Bloomberg. I think it was Liz Ann Saunders said it. It's been around for a while, but it clicked to me. It's called BRAIN. I guess it's biotech, robotics, artificial intelligence, and nanotechnology. But it could be something else. It could be energy tech. It could be a way to really, produce or capture all of the energy we all use in all of our devices. It could be something personal that we can carry around and charge things or generate, electrons for use. So I don't know what it's going to be, but that's the final, factor in that next huge long-term secular bull market or super boom, as we refer to it as.
We're on the line with Jeffrey Hirsch. He's the editor-in-chief of the Stock Traders Almanac. He took over from his dad, Yale Hirsch, who started it in 2001. Jeff, got a question for you coming out of the chat. Have there been any major changes in the Almanac over the last few years? Like perhaps what goes into it?
Yeah, there's been some major changes. There's some seasonalities that fall by the wayside. There used to be something, the September reverse barometer. We've added a whole bunch of things. We've got, the market probability numbers on each page. We've put in several different, we've added the Russell data. It used to be pretty much Dow and S&P. We've added NASDAQ and Russell 1000 and 2000. We've moved things around a bit. We put some of the forms online so that we made more room for the data. But there's always changes. Things keep, things get anticipated. Like in '87 when Yale first published the Trading of the Thanksgiving Market, It had been only down twice in the previous 35 years, the Wednesday and Friday, and then it got wiped out in '87. You see people anticipating things almost when it gets put out into the press. But I think some of the almost more important to me is the stuff that doesn't change, that you can actually rely on, like the best 6 months, and even intraday stuff, which, as I said, I don't really do, but I do intraday trading when I'm taking a position or getting out of one. All the talk of high-frequency trading has not impacted the intraday trading patterns. If you look at the back of the book there in the 140s, there's the half-hourly trading patterns. And if you think about it, look at it, you'll still see it happen with, sort of a dip around 10:30, a dip around lunch, a dip around 2:30, and then a rally into the close. It's very, it runs very close to the daily pattern that we all live in. You might go get a coffee at 10, you have lunch, you get that little lull in the afternoon, and then you're, taking your positions into the close. Some of the things that have been most consistent.
Jeff, before we let you go, I just want to get your opinion on gold here a little bit. Let's see if we can glean anything from the Almanac. Bullish article, Barron's, Randall Forsyth, very respected writer,
Yep.
and he was really making a strong case for the fundamentals for gold and did a great job. Is there anything in the Almanac or any indicators, or do you have any positions or opinion on the gold market? Big sell-off trying to get back above 1,200. Do you have anything in the Almanac that may help us trading gold in 2015?
Oh, sure. There's a recent article we put out, more of a seasonal move based, trading pattern, but also sets up technically for us. Long term, I think gold's had its heyday. I think there's a, counter rally here, and it's right into this. This is a very bullish time for gold. Fourth quarter, a lot of people are buying, gold for holiday purchases and that sort of thing. And technically, we just, sort of suggested getting back into the GLD around 112, which it did cross that level. So that's the area that we like it here. We think there's a base there. So it's not a long term, put it on, in the box for rainy day stuff, but it's definitely a seasonal and technical tradable pattern right here.
Okay, we've had Jeff Hirsch on the line, editor-in-chief of the Stock Traders Almanac, joining us here on Benzinga's Pre-Market Prep, brought to you Markify. Jeff, thanks a lot for coming on. Enjoyed getting a peek at 2015 Almanac, and hope to have you on again soon.
Most definitely. Thanks for having me.